Gold is on an absolute tear. Spot prices just smashed $5,200 an ounce. GLD is hitting fresh all-time highs, and central banks are buying like there's no tomorrow. But here's the big question every investor is asking. How long can this gold bull run actually last? And what does it mean for Bitcoin, stocks, real estate, and the rest of your portfolio? Today, we're breaking it down with history, hard data, and the latest forecast so you can position yourself the smart way. Let's dive in. First, the history. Gold bull markets don't last forever, but when they get going, they run for years. The 1971 to 1980 cycle delivered over 2,300% gains. The 2001 to 2011 run gave investors 650%. Our current bull started in 2015 and is already up more than 400%. These cycles typically last 8 to 12 years. That means we've got plenty of runway left. What's powering this one? Three massive forces. Central banks are in full accumulation mode. 260 tons in 2025 alone, on track for 800 to 1,100 tons in 2026. China, India, Poland, Turkey, they're all diversifying away from the dollar. Persistent inflation and the Triffin dilemma. With U.S. debt over 120% of GDP and deficits climbing, the dollar faces long-term pressure. Gold wins in both inflation and deflation, geopolitical risk and safe haven demand. From Ukraine to the Middle East and U.S.-China tensions, investors are rotating into real assets. Analysts are aligned. Goldman Sachs sees $5,400 by end 2026, bull case $6,000. JP Morgan targets $5,000 to $6,300. The World Gold Council and Reuters medians point to $4,700 to $5,000 in 2026, with a bull extending into 2028 to 2030. Bottom line, this gold bull has another 3 to 5 years of legs, potentially into 2030 or beyond, before a major top. We could see $6,000 to $7,000 gold and GLD $550 to $650 in this cycle. Now, the impact on everything else. Gold isn't just rising, it's pulling capital away from other assets. Bitcoin, once called digital gold, is feeling the rotation. Investors who wanted hard money exposure are choosing physical gold for its proven track record in crises and inflation. Bitcoin has corrected sharply in recent weeks as money flows into GLD and physical ETFs. Stocks, especially high-valuation tech and AI names, are losing some oxygen. When volatility spikes and risk-off sentiment kicks in, capital rotates to gold, putting downward pressure on equities. Bonds and the dollar face debasement risk. With yield curve control and massive deficits, long-term treasuries lose real value, driving more money into gold. Real estate and other risk assets slow as investors park cash in the ultimate safe haven. In short, gold's rise is a wealth rotation story. The more uncertain the world gets, the more capital leaves speculative assets and heads to gold. So what should you do? Use the core satellite approach we've built in the system. Keep 6% as your permanent long-term gold core for the multi-year bull, and use the tactical 4% to buy dips like the February trough at trim peaks. This way you capture the upside while managing risk. The gold bull is far from over. It could easily run another 3 to 5 years. Position yourself now before the next leg higher. Thanks for watching. Hit like, subscribe, and I'll see you in the next one. Stay golden.
Thanks for watching. Like, share, and subscribe to Dave's Market Explorer for more great content. Your support helps us explore more markets and bring you the latest insights. Thanks.